Hi everyone, welcome back to Investing Canvas, and today I'm going to walk you through one of my core systematic engines, and that's US momentum. So this isn't a highlight reel, it's going to be a full structural breakdown of why momentum works, why sometimes it fails, how it differs from investing in the S&P 500, the exact rules, the long-term results, and the trade-offs that you have to accept along the way. Because systematic investing isn't about finding a perfect system, it's about understanding return structure and how it's constructed as part of a portfolio. So let's get into it. Before we talk about rules, we need to talk about behavior. Momentum exists because markets are not perfectly efficient. We've discussed that in previous videos. If they were, prices would instantly reflect all information that's available at any point in time. So in theory, prices wouldn't persist. But that's not what happens. Investors underreact. Capital moves gradually. Institutions rebalance slowly, and trends build over time. And once a trend forms, it often persists longer than most people expect. And momentum isn't magic, it's a structural byproduct of positive or negative feedback loops, underreaction, institutional flows, risk management constraints. Now here's a deeper insight. Stock market returns, specifically within an index, are not evenly distributed. A small percentage of stocks often drive a large portion of the long-term gains. Most stocks are average, some underperform, a few massively outperform, and if you own everything equally, you dilute the outliers, and if you weight by market cap, you smooth dispersion. Momentum attempts to concentrate exposure in stronger momentum stocks while momentum exists. That's the philosophy. So to draw some obvious comparisons, why not just buy the S&P 500? As we know, the S&P 500 is market cap weighted. That means the largest companies dominate exposure. If a mid-sized company is massively outperforming and has very little impact on the index returns until it becomes very large by market cap, and that cap weighting is efficient for capturing beta, but it suppresses the dispersion of returns. Momentum does the opposite. Instead of weighting by size, we rank by performance strength. So we concentrate capital in stocks already demonstrating strength. The S&P 500 captures the market's average return, whereas momentum attempts to capture the market's leadership by capturing the strongest moving stocks. This increases volatility, but it can also increase the opportunity to outperform. It's a different structure, it's a different behavior, and it's a different pain point. Now let's get precise. The strategy operates across a broad US equity universe, but you can run this on lots of variations across different market constituents like the Russell, the Dow Jones, the Nasdaq, and you get varying returns. But at the end of each month, we undertake step 1. We rank stocks by a blended momentum score, and that score combines a 3-month, a 6-month, a 9-month, and a 12-month return, weighted towards the immediate time frames. So why blend multiple look-back periods, you may ask? Because momentum isn't a single speed phenomenon. Short look-backs react quickly, but are noisy. Longer look-backs are more stable, but they're slower to adjust. If you rely on a single time frame, for example, say 12-month returns, your returns become highly sensitive to the specific parameter choice. Markets don't trend at a constant speed. Some trends develop over 3 months, others persist over a year or more. So by blending the 3, the 6, the 9 and the 12-month returns, you're capturing multiple momentum horizons, you're reducing dependency on a single time frame, and you're improving stability across different regimes. It's not about precision, it's about reducing parameter fragility. And importantly, I'm not optimizing these weights to maximize backtest return. The blend is intentionally simple and stable because robust matters more than squeezing out a little bit of additional return in a historical backtest. So moving on to step 2, we apply structural filters. So the stock must be above its 200-day moving average, and the broader market must also be above its 200-day moving average. Step 3, we select the top ranked stocks. Step 4, we equally weight. And step 5, we rebalance monthly. So there's no discretion, there's no prediction, and there's no overlays. Now this is important. So when I show you the equity curve, I want you to pay attention to something. You'll notice that during major bear markets, say from 2000 to 2002, 2008, 2020, the momentum strategy avoids the deepest collapses. Now why is that? Because of the 200-day filter. When the broader market drops below its long-term trend, the system reduces or removes its exposure. It doesn't predict crashes, it reacts to structural weakness. Now if you compare this to buy and hold, Buy and hold stays fully invested, so when structural bear markets occur, the drawdowns are deeper and more prolonged. Now, momentum still experiences drawdown, but looking closely at the crash periods, the equity line flattens or decreases less aggressively rather than collapsing in line with the full index drawdown. That behavior is largely driven by the trend filter reducing exposure during sustained market weakness. It's not perfect, it doesn't avoid every loss, and it can get whipsawed during sharp reversals. But over long bear markets, it materially shifts the depth and the duration of drawdowns. Now, looking at the circled sideways periods, those are typically post-crash or regime transition environments. Momentum struggles when trends are unstable. So what you're seeing is the trade-off: reducing participation in prolonged bear markets, increased frustration during choppy, range-bound regimes. You don't eliminate the pain, you shift its timing and its structure. That's structural risk engineering at play. So from 2000 through to 2026, that strategy produced a return of about 16% annualized versus the S&P, which returned about 8%, and the maximum drawdown was about 35% in comparison to the S&P, which was about 57%. So by tactically using a momentum factor and being a little bit more active, you obtain higher long-term returns and you reduce structural bear market exposure. But the strategy does not outperform smoothly, it outperforms structurally. So in terms of managing risk, I equally weight my positions. Why? Because it reduces complexity, there's fewer parameters, and it has lower structural fragility. So there's generally greater robustness in the testing process. I know some investors that apply average true range based volatility sizing, and that usually reduces drawdowns slightly. It lowers volatility, but you also reduce some of the upside potential, because high momentum stocks tend to have higher volatility. Again, it's a trade-off. System design is about choosing your discomfort. A 35% drawdown is real. And remember that momentum can underperform for extended periods. If you chase performance and abandon systems during flat periods, this won't work. Most strategies fail, not because the maths breaks, they fail because the investors break the discipline, as we discussed in previous videos. So process matters more than prediction. But remember guys, the 35% is still a high drawdown, and this is not a complete portfolio. It captures one structural market behavior, and that's momentum persistence. Other strategies that you can overlay, including mean reversion, different forms of trend following across different asset classes. When you combine independent edges, the overall equity curve smooths. The goal isn't one perfect system, it's to combine different behavioral edges. And that is the true secret sauce of portfolio construction and risk management. Momentum is simple. It ranks strength, it filters weakness, it reallocates capital, and it repeats. And remember, it does not forecast, it does not interpret narratives, and it does not rely on any opinion. It exploits behavioral persistence, and over a long time horizon, that persistence compounds. So guys, with all that said, in the next video, we'll look at how combining momentum with a fundamentally different strategy changes the portfolio behavior, and why diversification across edges matters more than optimization within one strategy. Thanks for watching, and I'll see you on the next one.